Welcome to Straddle Income. We're here to help you make money. And this week, we're going to continue to talk about trading options. And we're going to start first by introducing to you a very straightforward and simple and basic strategy called call options. We're going to talk about two parts about the call options, how you can buy a call and how you can actually sell a call options. For each of the strategy above, we're going to describe what is the strategy about, how you can actually set it up, characteristic of the strategy, when do you use it, and the mechanics in closing the trade, so you can walk away with a nice, decent profit. If you have not had a chance, making sure to subscribe to our channels where we talk about how you can make money every day. Okay, talk about buying a call. The way you can say that to other people is very straightforward. You can say buy a call on SPY at $295. Or you can also say I want to do a long call on SPY for $295. The definition of above is basically if you're the buyer, you're buying a call on SPY at $295. You have the right to buy SPY stocks for 100 shares at $295 per share before the expiration date. One option contract is equivalent to 100 shares. And if this sounds not very familiar with you, I recommend you watch the video from last week where I talk about how you can actually benefit by trading options and what is the basics about option tradings. I'll leave the link in the description down below. Now let's talk about how you can actually set it up on tastyworks and think of a swing. Here is the platform of tastyworks. You're looking at the SPY options, and for some of you who haven't not seen this platform before, I recommend you watch the video from last week and the week before where I talk about what other popular trading platforms people use to trade options. tastyworks is one of those platforms. For example, here, what you're looking at is basically all the option contract with different expiration date. So you have June 24 expiration all the way to June 18, 2021 expiration. When it's actually more than 1 year in the future, it's called a leap contract. So for example, we're looking at Jan 15, 2021 option contract for SPY. Let's expand that. Here are all the details of options traded expiring at Jan 15, 2021 with different strike price and different premium. The price of SPY contract is currently traded at $295. So at $295, this is the contract that's in the money. And for the contract that's out of the money, here is the very first one, which is $223.67. That's a premium you have to purchase for the contract strike price at $296. So let's don't worry too much about that. For example, let's focus on the $295. Let's look at the mechanics. You click that. Basically, the bottom panel will open up and it tells you the details. You're buying a contract of $295 expiring Jan 15, and the price for that contract is $24.27. Again, you have to keep in mind, this is about one option contract. So really, you're talking about you're paying $2,427. Let's look at the option contract here for SPY. Scroll all the way down. Here is the part where everything is in the money and everything is in the money for the put contract. Please focus your attention on this part right here. $295, that's the strike price, that's in the money. We're buying this contract. Again, Think of Swim does a really good job to tell you what is buy, what is sell. And I explained the definition of each in the video last week. So let's talk about how we can actually buy a contract. You click that. Basically, it gives you this idea of single buy. Since this is a simulation account, let's make sure that we be more realistic. We're buying one contract of SPY, Jan 15 expiration date, $295 strike price. With the price you have to pay for $24.27. This is the same price you see from the tastyworks earlier. You click confirm and send. Here is all the details, which we'll talk about immediately in the next slide, or the characteristic of the call options. So the characteristic of a long call strategy is very straightforward. You have a limited risk. You have a defined risk when you trade a long call. And your upside, your profitability is unlimited. As stock keeps on going higher, you will again be benefit from that. You have to be mindful of the break-even price. The break-even price is the point where if the stock is above that price, you start making money. So we're talking about if we would trade a SPY at $295, the premium you paid, you saw earlier, is $24.27. Basically, what it means, the break-even price is $319.27. You can visualize all those details in this thing called risk graph. Here is the risk graph for the trade we're talking about. The purple line is the risk graph for the current date, May 25th. The light blue is the risk graph of the option contract we're interested in, which expires in Jan 16, 2021. Here's the detail, the single by $295 and the price you're paying. You can see the break-even price, which is highlighted here, is denoted at $319.24. Beyond this point, you actually start making money. As you can see, your profitability goes above zero. And when it's less than that price, you're actually losing money. But your risk of losing is defined as capped at $2,400.27, which is the price that I'm indicating on the top. Let me show you how you can actually visualize that. Let's close this detail here. Let's open it up. So Think of Swim does a good job. It gives you this function called Analyze Trade. Click that. Let's remove the expired information. Here is the risk graph I'm showing you here. Let's set a break-even price to the option contracts that are about to expire in January 16, 2021. See, this is basically where it indicates that above this point, you start making money, but below, you're actually losing money. And your maximum loss is capped at $2,427. Coming back to this, it's always very important that you have to define your own exit strategies. Point where you are comfortable walking with a decent profit, and the point where you're also comfortable of losing and don't hurt your account too much. We'll talk about exit strategy in the future videos. Coming back to the option contracts, buying a long call, what is the mindset and when do you actually use those strategies? You use the option long call strategy when you're very bullish about the underlying. You have a strong confidence that the stock is going to go up or the ETF is going to go up. The number two reason most people like to use long call is when they have a small capital investment. They don't have a sufficient fund, but they want to be able to join the party. Example we were having earlier, we're talking about SPY traded at $296. If you were to buy 100 shares of that, you're basically putting the capital investment of $29,600. But the option contract you saw earlier is traded at $2,427. This is much smaller capital investment requirement versus buying 100 shares of SPY shares. The other reason that people like to do call is when they wanted to take some risk. And then when I say take some risk, I actually meant a lot of risk. So this is a thing called a lottery ticket. Basically, when you trade an option, for example, you trade a particular stock at Facebook, it's currently trading at $290. But Facebook reports earning in the next couple of days. And from what you have seen, you have very high confidence that Facebook is going to report a very good earnings. So you're buying a far out of the money call options at $325. As you can see, this is way beyond the $290 price that Facebook is currently traded at. Because it's so far out, it's not very likely to happen. The premium you pay for that is very small, it's $80. But you never know. 3 weeks later, Facebook is traded at $324. You're almost in the money. And the price you're paying for $80, if you were to look at it and try to close it, talk about 10 times profitabilities. You're buying a call with a premium of $80 because of the fact that it's so far out of the money. But then 3 weeks later, Facebook is trading at $324. And now you're at the edge where your contract is about to be in the money, and you can enjoy a lot of profitability from. So this is, again, a very, very risky trade. It's called a lottery ticket. As you can tell from the name, it's small chance of happening, but if you were to able to capture one of those opportunities, you can walk away with a very nice, decent income. All right, I'm just going to stop here for talking about the call options.